Once again, we are going to look at for the IFRS's, the International Financial Reporting Standards, and then we look at for how it affects the preparation and the presentation of financial statements. So not just the IFRS's. We are going to look for the IFRS's in two different folds. Number one, on its own, the theory. So the IFRS is on its own. Number two, how we are going to incorporate it in the final account, the preparation of the financial statement. Know that the professional exam body examines standard in two different ways. So the standard on its own, 20 marks. As a footnote, another 20 marks. So the profit and loss account will be some standards that come under it. Again, the standards, few of them will be selected and then be on its own, meaning that we are doing two topics at the same time. We are doing two topics at the same time, meaning that we are going to look out for standards on its own and how we should adjust them with respect to the final accounts. That is all. So starting with, we start with the IAS 2. IAS 2, International Accounting Standard number 2. So number 2, that is IAS 2. Good. IAS 2. It talks about accounting for inventories. Inventories. IAS 2 talks about inventory. Now these inventories or these standards, if you pick the standard, there are 5 items that you should know basically. Although there are lots of issues in the standards, but only 5 items that you should know. In fact, out of the 5, I'll cancel plenty of them and leave few. If you appreciate the standard very well, the preparation of financial statements will not be a difficult section, no. Now, inventory, when you pick every standard, item number 1, you should know the objectives and what scope of these standards. Item number 2, you should know some terms. Every standard comes with some terms, some definition, explanation, some types, some treatment, some condition. You should know those terms. So that is basic definition of some terms. From there, you go on to recognition criteria. Recognition criteria. Number 4, we go to measurement. Then number 5, we talk about disclosure requirement. Disclosure requirement. So all the standards that we're going to look out for, kindly make sure that you know these 5 items under all the standards. Now we've gone through how they set the standards. Even look at who even set the standards. We went ahead to look out for the good news and some bad news of the standard, the IFRS. Great. So now I'm going to look at the individual standard one after the other. Now, let me give you a general objective. Objective of every standard is to prescribe the correct accounting treatment of that standard. The standards look for specific treatment, and the standards gives specific treatment, or the standard treats a specific transaction. So all inventories are treated under IAS 2, except those ones covered in other standards. Fine. So in short, when they ask you for objective of every standard, tell the examiner that the objective is to what? Is to prescribe the correct accounting treatment of that item. So long as you know the name of that standard, you should know the objective behind. Why they worry themselves to bring these standards? If you know the name of the standard, you should know the objective. So if it is inventories, then tell the examiner to prescribe the correct accounting treatment of what? Inventory. If the standard is about, let's say, IAS 12. IAS 12 talks about income tax. So as long as you know the name, you should know the word, the treatment or the objective. The objective is to prescribe the correct accounting treatment of that item. Okay, that is all. So the objective of IAS 2 is to just prescribe what? The correct treatment of inventory. So IAS 2 give us specific treatment. Do it this way and that way, that's all. Unlike the conceptual framework, which was given us a general guidance, but the IFRS give us what? Specific. Good. Let's go to the scope. The scope is about coverage. Does it cover all inventories? No, not at all. It does not cover all inventory. There's exception. Good. So the exceptions are: number one, biological assets. Agricultural produce. So if I'm a farmer and I have some cocoa beans there, cocoa beans are my produce, are like my inventory. That's what I sell. That's what I deal in. That is my trading stock. Good. So that is it. So it covers all inventory except the following items. Those ones, as someone they need, I will keep them in. So just bear in mind that the scope talks about the coverage, because every standard and what it treats or specific requirement is prescribed. So the scope, now let me give you a trick behind the scope. It covers all inventory except those covered in other standards. Some of the standards have different versions of inventory. For instance, if you deal in like the cocoa that I said, if you produce cocoa, the cocoa farmer, and then the cocoa beans, you have some there, it's your inventory, it's your stock. But IAS 2 will not cover it because there's a full standard that talks about cocoa beans. That is agricultural produce, IAS 41. So if that item has been covered in other standard, then it will not be covered here. So that is the scope. So, like example that I gave, cocoa beans. So cocoa beans. There's a full standard that talks about cocoa beans. IAS 41, biological asset or agricultural produce. Now, agriculture talks about cocoa beans. Cocoa beans is there. So IAS 2 inventory, even though cocoa beans will also be an inventory to a cocoa farmer, it has not, the requirement is not extended there. It's like everybody and your territory, what do you cover? Even if you take the water bodies, their demarcation, even for the large water body, there is demarcation. Like you have what? Sea, which is different from what? Gulf, which is also different from what? Ocean. I like that. In fact, even different from bay, right? Lagoons, and then other people. Lakes, rivers, streams. But I'm talking about the large ones, the three large water bodies. What's the difference? Sea, Gulf, and ocean. Or they are the same. Even if it takes ocean, there's even demarcation between these oceans. Atlantic Ocean, Pacific Ocean, those ones, in fact, when they meet, there's a thin line, their waters, the color is even not the same, form a nice tourist site. That tells you that you can't cover everything on this earth, no matter what. You have a territory. Yes, like the president of Ghana. Like any item, you have your territory, so stay within your terrain. That is the scope. So if it falls within your terrain, fine, move on. Now we go to some terms. So about the terms. In all, what you should pay maximum attention is the recognition and the measurement. That is all. These two sections. If you don't understand anything, these two sections, that is all. That is where the actual question will be from recognition and measurement. Kindly take note of that section. So that, in fact, all questions are coming from that angle. We don't even ask questions on scope. Objective, no exam now asks you. Scope, no exam now asks you. Why? Because the answer is just one. The exam, you know the answer already. If I ask you what is the objective of IAS 44, and I tell you the name of that standard, even though it doesn't exist. If I tell the name of the standard, you should be able to tell me what the objective, because it's like a template. You just have to insert the name of that standard in. So for instance, objective of IAS2 is to prescribe the correct accounting treatment of inventory. Objective of IAS12, IAS12 talks about income tax. So the objective will be to prescribe the correct accounting treatment of what? Income taxes. That's all. You are done. Scope, it covers all taxes except those covered in other standards. That's all. So this question, do you have to ask you in exam? No way. Even if you are dashing marks, don't do that. It's not an exam question. So, fact, it's just for formality. Let's go to terms to make it complete. Terms. Now, the terms are some standard definition given to us, and that one we should be familiar. You may be asked to define them. Some of them are technical. Those ones, you need to know them. You may be asked. When I reach there, I'll let you know that these areas are a bit slippery, so just hammer there with care. So I'll start with the terms. First, I'll look at the definition of inventory. What is inventory? Inventory is an international name, and stock is the local name. So let's look at the definition of inventory. Tell me inventory or stocks. People also call it trading stocks. Okay. Define inventory or stocks for us. Now, when we talk about inventory, in fact, is just what you use in goods that you transact. So basically, the standard define inventory as an asset, which comprises of what? So inventory is an asset which is made up of or comprised of. So inventories are assets. They are assets that comprise of one, I'll read them for you, raw materials. So if you are a manufacturing company, you have some leftover of the raw material, or you are, let's say, a bakery firm, or an industry or a factory, and there's some leftover of flour, it should be part of your inventory. It should be part of your stocks. Good, because it has not been consumed yet. Until you consume it, it's not an expense. Yeah, take note. Expenses are consumption. So that's why you can even pay, but if I've not consumed it, it's an expense. Like the example that we just looked at, rent. They are paid for more years ahead, but because they have not consumed it, we are not treating it as an expense. That's what I apply to this. So raw material. Number two, talks about work in progress. Work in progress. Work in what? Progress. Now, work in progress is partly finished goods. At the date that we're going to financial statement, some of the goods uncompleted. It's semi-finished. So how do you treat those figures or those values? We are saying that those they are assets or current assets. Number three, it's made up of finished goods. Finished goods. Finished goods. Finished goods. Number four, consumables or production supply or component. Consumable production supply or component. That's number four. Consumables or production supply. These are examples of what? Inventory. These are examples of inventory, basically. Okay, let's do something in here. Another term, some of the terms, they are a bit technical, so I don't define them now, because if I define them now, so as and when the need arise, when we get there, then I'll define it there. That one is a bit fine. So now I'll define only inventory. So I'll run away to recognition. I'll throw more light on recognition of inventory. Inventory is like a trading stocks. At the point in time, it's open inventory. At the point in time, it's closing inventory. So what's the treatment? And those two inventories, they don't have the same treatment. But how you treat closing inventory and open inventory, they are not the same. Good. They are not the same at all. Now, the open inventory is written off against P&L, meaning it's treated as an expense. Closing inventory is not an expense. So let's see their recognition. Now, before I start, let me explain recognition one more time. When they ask for recognition, we are just saying that recognition talks about how the item should be recorded on the financial position or the financial statement. So recognition. When you talk about recognition, we are just asking, how are you going to treat that item? Is it one of the real? Is it revenue? Are you going to record it or recognize as revenue, expenses or equity, asset or liability? That is all. That is the meaning of what recognition, how the item will be recorded or treated. It can be recorded as an expense. Well, if it meets that criteria, fine. Now what happened is this. If I go to recognition, if I did this, I'm going to start an example, and everybody will tell me whether it's an inventory or it's not an inventory. Inventory is just an asset which is made up of raw stock. We mentioned raw material. We mentioned work in progress. We mentioned finished goods. In fact, the finished goods, it can be the one at the warehouse, postal joint, and any distribution outlets. That is the inventory. Okay. Provided that you have control over that distribution center or outlet, why not? It's an inventory to you. Now let me give this example. Assuming that we are a bank. And then I don't know if every year we do adoye to our employees by giving them at least Xmas bonus. No, not even Xmas bonus. We give them a Christmas gift. So normally we pass them nice hampers in the form of rice and other Xmas gifts. We pass them nicely. So one of the years we ordered for those items. They brought in plenty. We shared, but they're still left over. We are bummed. We don't produce rice. We have about 1,000 bags of rice in excess. How do you classify this? Should we classify it among, is it an inventory to us or it's not an inventory? Is it a stock? It's not a stock. So how do we treat that one? Tell me how you are going to treat it. Right. Great. I'll answer this question in two folds. First here and second after recognition. I'll still answer it again. First of all, when you talk about inventories, sometimes they go beyond what you do in. Yes, we are bank, we don't produce rice. Then how come the rice get its way to our factory? Through purchases, good. So we can what? Acquire goods that we don't produce. Fine. Now, what happened is this. Let me give the worst case now. What if you don't account for it? It will not be on the balance sheet. You write it off, right, as an expense. And meanwhile, you have not consumed all the rice. There's leftover. It has not been consumed. And you know that expenses are items consumed during the year. There's no expense that should be there. Unutilized expense, no. So expense, if you have not consumed that expense, then you can't set it at probably through payments. No. So what happened is this. If you don't account for it, let me give you a worst case now before I come to, I'll give an accounting answer. What happened? Start here. And by the time you realized, do this as what? Self-pay. Oh, you do some work. Oh, this one I best left over. Let me pick one. I pick a bag, two, a bag, two, a bag. But I realized it has not gone from 1,000 bags up to what? Just 150 bags. Yeah. But if it's on the balance sheet, the accountant is responsible. So if I pick it up, no, this one has been accounted for, please look at it. It has been accounted for. So bring an authorization before I can give you even a bag. Even a single grain. If you want to pick a single grain, you need an authorization for. That is it. Now let me give you a accounting answer to this. Now, this is an inventory because it forms part of the consumables. Consumables are items or they are other items that are not necessarily within. We don't need in, but it helps us to produce what you want. Without them, you might not be able to produce what you want. Yes, in fact, serving our hard-working customers at the end of the year is also part of the production process to motivate them. So inventory or the leftover rice will form part of what? Consumables. So it might be part of the inventory sitting comfortably on the balance sheet, enjoying current assets. That is it. Then, and also ask this. Now the checkbooks that the banks gives out. Assume that during the year, you have about a lot of them left over, yet to be issued to the customers. A lot of printed checkbooks are around. Or you even have some of the documents that you normally give out to the customers. You even sell to the customers, fine. Some of them are left over. Admin cards and other documents. So those documents will be part of inventory. Yes, the inventory. The inventory, how we get it. Even though you don't probably produce them yourself. So inventory normally it's trading stock plus other stocks. So let's take notes. I'm done. Let's go to recognition of inventory. How do you record inventory? Your trading stocks. So inventories, it can be leftover goods or goods acquired. So how do you record them? Now, the recognition varies. How we record the inventory, it varies. It depends on the type of inventory. Basically, there are three types of inventory. We have leftover and brought in. So, let me give an example. So, goods. So, there are two types of inventory. They have different recognition. Sold inventory or stocks, or inventory or goods. So goods or inventory, what is the treatment? Let us examiner. At the end of the day, all goods, all stocks that we have been able to dispose of, it is an expense. It is an expense. That is all. To be specific, which type of expense? This goes to cost of sales. Let us examine that. If these goods I'm able to sell them, it should be part of my cost of sales. And then give you a type of, that is open inventory. Sold stocks are open inventory. So they are open. So that is why if you want to calculate cost of sales, it tell the examiner, open inventory plus purchases. So cost of sales is a direct expense. So far as you are adding open inventory, meaning that you are treating this as what? As an expense. That is all. So tell the examiner, if these goods, all the goods sold during the year, they are what? They are expense. Charge them against your profit and loss. That is all. So charge them against your profit and loss. Yes. Because it has been used to generate what? Revenue. So those rights that you are sharing to your staff, hard-working staff, it will be used to generate what? Revenue. So it must be matched. Now let's go to the type 2 or the other type of inventory. You call it unsold inventory, leftover. Type 2. Fact, with leftover. We call it unsold. Unsold stocks or inventory. Now, the unsold stocks or inventory, that is the closing inventory. The treatment is that all closing inventories are treated as an asset. They are what? Assets to the organization. Thank God. So they are treated as what? Assets. To be precise, current assets. So they are treated as what? Assets. To be specific, current assets. No wonder in our balance sheet we see what? Current assets. Inventory under current assets. That is examiner. Any unsold stock left over should be a current asset on our balance sheet. So the rights that we acquired, the leftover should be a what? An asset, current asset. Now, any item that you have acquired, but you have not consumed it in this year, it must be carried forward. That is all. Now, understand this point very well. Any item you've acquired, you've paid for it, They've acquired the goods, but they were able to consume them this year. It should not be part of this year's expense. Not at all. That one is not an expense for this year. Because if not consume it this year, expenses are those that you've incurred or you have what consume it. Take note. These goods are not being consumed, so there can never be an expense for this year. These goods, if not consumed them, there cannot be an expense. So any goods that is left will be what? A current asset. It's not an expense. That is why we list what? The closing inventory and add it back to that of the current assets. And done with the recognition of inventory. It explains how we treat inventory. So at one point in time, inventory is an asset. At another point in time, inventory is an expense. All of them have what balance? Debit balance. Good. So that will balance nicely for you. So one is closing inventory and one is what? Opening inventory. Okay. Okay, now let's look at the measurement of inventory. Measurement simply means how do we get the value? Now that we know how to treat inventory, what left is the value. How to obtain the value. That is all. That is all what I'm talking about. How to obtain the value. So assuming that you are a manufacturer, you are not even a manufacturer, you bought some goods. You know, if we are a wholesale company, we don't manufacture. We go and buy and then just push it out to retail companies and then they'll go and then dispose it off. So, you know, our main form of inventory goods, the goods that we've acquired, that's the purchases, the stocks that we acquire. We are not going to manufacture because we don't manufacture goods. So now how do we obtain the value of this inventory? That is all. Please establish the view. If you don't understand anything under IAS 2, not what I come to do, how to measure inventory. Measurement simply means how to obtain value, and recognition simply means how to record it. So two words. It was recognized and measured at, meaning that it was recorded and valued at this. So can look at how we state our terms. It's very important. Yes. Everybody or every profession and then their terms. Financial reporting, one of our terms is what? Recognition and what? Measurement. Yes. And you have your terms, right? Thank you. Like votes. Let me move on before I put myself. Okay. Measurement. Measurement basically explain how we will obtain the value. Now that we know how to get it. So measurement. Now when you talk about measurement, basically there are two types of measurement. We have what we call initial measurement. The word initial measurement simply means if I acquire goods today we manufacture some goods, or today went to the market, acquire some. Let's assume that we don't produce, we buy and sell. Good. We have rice. In fact, we buy rice from the wholesale joint or from the farmers, and then retail it to the final consumers. That's our job. That's all. We don't have time to produce rice, no. Or we don't have the expertise to produce the rice. We only know how to sell goods and how to add our profit to it and sell and locate the customers. But we don't know how to produce the goods. But that does not mean that we cannot sell, we can enjoy. So assuming that January we bought some goods. So we say initial treatment simple means the first day that you bought the goods, what will be the value are you going to record? So what is the value? Almost all initial measurements, they are costs. So initial measurement of inventory 2 is at what? Cost. So that examiner. Initial measurement of inventory is at what? Is at cost. So initially inventories are measured at cost. So tell us that we measure it at what? Cost. Very important. At cost. Initially, inventory should be measured at what? Cost. So just cost is another term that the standards define it for us. You should know the definition for what? Cost. So let's see the definition for cost. Now, when we mention cost, we are saying is the what? Cash and cash equivalents or fair value of other consideration that you transfer to obtain the goods or the inventory or the assets. That is all. So when I talk about cost, that examiner, it is what? Cash. And I'm giving you cash. It's cash. And what? Cash equivalent. I can give you something. The thing is not cash, but it's equivalent to cash. And the date I'm giving to you is not cash. Maybe I bought some goods from you. I don't have money to pay. So somebody is also owing me. So I quickly call the person and directed the person that please, when it's time for you to come and pay me, pay the money to this person. Because me too, I'm owing the person. I can't even give the money to the person. So sign. Everybody agreed. I've bought the goods, but I didn't necessarily pay cash. I use what? Cash equivalent. Cash equivalent or fair value of other consideration transferred. Of what? Other consideration transferred. Now I can come and then work for you. Instead of you paying me, I say no, don't pay me, boss. Give me goods. Let's go and sell and get money. Fine. So we can go and help a farmer. We can go and wait for a farmer, and the farmer will instead of him paying us, so no, give us rice. We go and sell the rice and get more money than what they're going to give us. So give us rice. From the farm now, give us rice. Let's sell the rice together. So we are saying that cost of that rice is the same as the fair value, the amount is supposed to give it to you for you weeding the farm. So you are saying that the cost is starting by either money that you paid or anything you give to the person which is equivalent to money. By itself is not money. Or if better still, any item that you swapped. Swapping, I mean saying you swap any other item to obtain the goods. You can go to Circle, you are going to look for goods to come and then buy. You go there, you don't have money, but you want to also sell the current phones. So you go there, gather all the old phones that you have, give it to them, add little money to it, let them give you new phones so you come and sell and get money. Now you did not acquire the new phones with the fiscal money. You give them a little cash or sometimes no cash, and you give them other consideration. You transferred other consideration. That's swapping. Good. That is all. So that is the meaning of the cost that we are talking about. Simple means cash and cash equivalent or fair value of other consideration transferred to acquire the assets. So that is it. Now this course we have composition. In fact, you're going to meet what you're going to do 3 times before you write the exams. That is why I'm taking my time to explain it here. So that the second time, I just hit something small and then run away. The third time, I'm not even doing anything at all. I did this. Do you remember? They say yes, then they move on. So something I'm going to meet it 3 times. It's under 3 different standards. first, second, third. So the first one, I will have to make sure that you get everything. The second time, I will explain it little again. But the third time, I don't know if you mentioned it at all. I tell you that, do you remember? You say yes, then we move on. Okay. Now let's see the composition. Now, when you go and buy goods, you will incur a whole lot of cost. Not all of them, the standard allows us to add it. Take note. If you probably you go to Makola to acquire some goods for your business, by the time you move the goods from Makola to your warehouse, or by the time you move the goods from your market to your warehouse or to your shop, you have incurred a whole lot of cost. Yes. You incur a whole lot of cost. Not all of them the standard allows you to add. So we have what we call inclusion of cost of inventory. Now, there are only 3 primary costs. Each of them have subunits. The first one is purchase cost. Purchase cost. I'll explain that one. Have a lot of items under it. The next one too also have a lot of items. We call it conversion cost. Then last one, any other costs incurred necessary to bring the asset or the goods into their sellable state. Okay. So these are the 3 costs. I'll pick each of them and explain it a bit detailed. And we start solving questions under them. Purchase costs. When you talk about purchase costs, it's comprised of number 1, the purchase prices of. So write this one down for me. Number 1, purchase prices of. Purchase price. Number 2, transportation or carriage inwards. Transportation or carriage inwards is part of the cost of inventory. Transportation or carriage inwards. Handling or delivery cost. Handling or delivery cost. You know, some of the goods you need to handle them with care. Look at how they transport the some of the equipment or the glass windows, and then the structures that have fragile elements. For instance, look at how they transfer the glasses that normally the louvers, the large ones. They need to have a triangular wood on the vehicle to just separate these items to the extent that they don't probably oppose. Other than that, a little touch slightly can break all of them at a go. So let me repeat again. Purchase costs include number 1, the purchase price. Number 2, transportation, handling, carriage, delivery. All these are the same thing. Transportation, handling, carriage, delivery, they are the same thing. So they are 1. Number 3, import duties. Sometimes these goods you import them and you pay duties on them. Kindly add it to it. It includes what? Import duties. Number 4. So number 4, it includes irrecoverable purchase taxes. Any tax that you pay on these goods, you bought the goods, they've asked you to pay tax, maybe VAT, you pay VAT, or you pay some special duty, special tax. No, some of the goods, you ask you to pay some special tax on it before they allow you to bring the goods. So I can give you one. That recently, even though it has been abolished, There were some taxes such as the luxury vehicle tax. That's all. Please and please again, if there's any recoverable tax, don't add it. Don't treat recoverable tax because no situation whereby you can recover the assets. No. So take note. Let's trade discount or similar rebate. What is trade discount? Trade discount simply means you bought a lot of the goods at the same time, so they reduce the price for you, or they give you extra. Now, when you talk about discount simply means reduction of price due to bulk purchase or prompt settlement. Either you are buying more of the goods at a time, or you are paying on time. That's the main reason why companies will give you a discount. Number one, you are buying more. So that's a good in the market. They'll tell you that buy 3, get 1 for free. That's a trade discount or a bulk discount. We call it trade discount or bulk discount. Trade discount. That one is on what? It's on the goods. When you buy more, buy 3, get 1 for free. Or if you can buy it from, let's say, 55 tons going, we'll reduce the price for you at, let's say, how you buy printing. Normally, if you print more, the cost becomes less. As you print later, yeah. So that is it. What you don't want is what you call cash discount or settlement discount. Those ones is for those who pay the funds on time. Pay their funds on time. Good. Then conversion cost. Let's go to conversion cost. As the name suggests, conversion cost. Conversion cost. Now, this is the cost that you incur, but the conversion cost is the cost that you incur to convert the raw materials or the raw stock into their finished or semi-finished, in fact, or to their sellable state. Anytime you need some process to convert your raw material or to convert your inventory into what finished goods. So let me give you a practical example. It's, in fact, we are talking about manufacturing cost. Manufacturing cost. Sometimes you need to manufacture the goods yourself. You buy the raw materials, you need to now clean, start the process when you are manufacturing goods. So that's the conversion cost. Cost incurred to convert the goods to their finished state. Basically, it's made up of directly attributable cost. That's all. Okay, now the conversion cost usually refer to the labor cost and the overhead. You know, some of the goods, let's give an example. We said that we are wholesalers of rice. We buy the rice from the farmers. In fact, we are retailers. We buy the rice either from the farmers or from the wholesale joint on nice scale, and then we retail it to what? The final consumer. So let's assume that we have a team that normally we build the rice and then put it in small quantities, like a cup of rice, maybe a loca, maybe margarine. So we have been pouring it and then we bag it again. All this one, it means that we are converting the raw rice that we bought. Now converting this rice into something that customers will need, and that is the conversion cost. Either we are converting to a finished product or semi-finished, irrespective of the status. Once we have it. The next one is called any other costs incurred necessary. So other costs will include any other costs incurred necessary to what? To bring the asset to their present condition or location. They include the following. Number one, site preparation cost. Now, the other costs, can give an example like if you are selling water, you can't put the water on the bare floor. Need some structure, raise some structure on the pallets, and then put the water on. All these are what other costs incurred necessary to bring that into the present condition. Now, the following costs are excluded. Excluded does not mean go and subtract it. No. Excluded simply means do not include it. However, when the examiner asks you to treat it, tell the examiner that it will reflect in the P&L. It must be written off as an expense. It should not be capitalized on the balance sheet at all. So let's go at the exclusion from the cost. Number one, storage goods of finished. Number one, the cost that when you incur them do not include. Storage cost of finished goods should not be part. I will call it exclusion from the cost of inventory. Number one, storage cost of finished goods. Number two, general and admin expenses. Number three, initial operating losses. Any operating losses that is ignored. General admin ignore. That is all. So scan to some few questions. Take them as trial, then we are done. Our next meeting we look out for the full treatment of the second type of the measurements. Then we'll solve more questions than this. Okay, so looking at this particular section, we look for inventory figures. So every company has a cost in relation to the item of okay, so let's count it together. Material will be part. Material cost will be part of the cost. Yes, material will be part. So it's cost of finished goods, no, it's not be part. Yes, material will be part. So it's cost of finished goods will be part. This is a finished goods, so this will not be bad. So storage cost of finished goods will not be bad. Delivery to customers will not be bad. Okay, so the storage cost of finished goods must be ignored. Delivery to customers to yes, will not be bad. Delivery to customers will not be bad. And then first, recoverable purchase taxes. Okay, irrecoverable purchase taxes. Yes, that one should be passed. Like, should be the 70. At the end of the day, you get 70 plus 60. The 70 plus that of the 6. So the answer is 76. The rest, it has to be expensed. All the exclusion from the cost should be expensed. Right. So these are best solutions. Upon this material, you only get it. Can you continue with the solution? Okay, so now to solve this particular example, before we go, our third examiner, value of the inventory, cost of the inventory. First item on the list. I just have to, if I'm looking for cost, you are interested in the inclusion and then the exclusion. So check the item, whether it should be included or not. Materials, it should be past 70. Right, the material cost. Then storage cost of finished goods is then to go to P&L as an expense. Delivery to cost, no, to go to P&L as an expense. Then irrecoverable purchase taxes, yes, that's what we want, 6,000. So irrecoverable purchase taxes. That one happen to be. So the irrecoverable purchase taxes is what, 6, right? Put all of them together, I get 76. So that's the total cost of inventory. That is all.